Welcome back, dividend and value investors. Hey, today I'm going to discuss my thoughts about Intel's earnings. They were bad. I'm sure you have noticed that. Whether you own them or whether you saw it on social media, it was definitely the talk of the day. But if you're following me on one of the social media platforms, you have probably noticed that so far I've been withholding me from my opinion. Why? Well, simply, I have learned over time to not act on my emotions and study first. That's what I did. I slept 2 days actually perfectly fine because it's a small position in my portfolio, but now I feel I got my rational mind back. So today's video is therefore really about two questions. First, is the dividend safe? Secondly, what will I do with my shares? Are you ready? Let's get into it. So guys, the earnings were really a shit show, I can tell you that. Look at that, 14 billion revenue, down 28%. A much lower gross margin than last year, 43.8%. It was always in the 50%, and an EPS of 10 cents. Come on, the dividend is even 36.5 cents, so the dividend is not covered, down 92% year over year. Fair though to the CEO and the board, they already downgraded in October. We've seen the action at that moment in time in the stock market, but still there the gross margin and the EPS were lower than they thought it would be. So this just shows what a shit show it was. It was really bad. Credit to management though, because I do enjoy reading their 10K, not from a content point of view or the actual matter that they are writing about, because that's horrible of course, but they give us really nice overviews of where the differences are, also per segment, but also for instance for the gross margin. So you can see here 4.6 billion less because of the CCG revenue. This is everything around the notebook sales and the desktop sales. It shouldn't come as a surprise. We saw on Monday already the earnings from Microsoft. I believe they had a 30% decline in Windows OEM. I'm kind of scared already what HP Inc. will do. That will also be very interesting when their earnings come up, and I expect something similar there. Now, if you're interested on why that is, you can read a little bit more up into it, into the 10K, but let me summarize it for you. Effectively, high inventory levels due to customers bringing sales forward, the sales that actually Intel enjoyed the last 2 years due to COVID and the supply chain issues, and at the same time a weaker consumer demand. And I can really relate to that because buying a new laptop, not my biggest priority, right? If I first need to pay my gas bill plus my 10% interest on my mortgage, that's reality. And companies like Intel, Microsoft, and definitely also I know already HP Inc. are feeling this because they are really sensitive to consumer spending as well. But also here 3.3 billion lower in data center revenue. They are just not so competitive as they like to be, but also the big cloud players like Google, Microsoft, Amazon are also, as they showed, investing a little bit less in this to save money and really boost up their earnings on their side. And in that case, Intel is just in a weaker position in the supply chain. Of course, also Intel itself is facing with inflation numbers. That's also clarifying some of these numbers. So overall, a really big gap between 2022 and 2021. Most of this was already forecasted by the board of directors in October. So that's when we already got more info in this, but it looks even worse than we expected. Share price wise, you can see the company went nowhere over the last year, 41% down. And also the reaction to the shares was around 6% the day after they announced the earnings. So for me then, there are really two questions, right? What with the dividend? That's the first question that I will answer now. Is the dividend safe? And secondly, what will I do with my shares? So if we look at the dividend, right? First of all, let's remember what this is about. This is really a dividend growth story. They started really hiking the dividends again in 2004. They went from 8 cents per annual per share to 16 cents. That was a double of the dividend to 1.46 in 2022. Their recent announcement was to maintain the dividend at 36.5 cents per share, while we usually would have expected now a dividend hike. And there was a poll on Twitter the other day, and I would say most of the community actually expected a maintenance. So from that point of view, it is again a little bit as expected. But now comes actually the interesting part of this whole story. Look, the company is currently yielding 5.18%. That makes it really attractive, I would say. One of the higher yielders in this market. But look at the wording. At the end of Q2 2022 earnings, so let's say 8-9 months ago, so let's say 6 months ago, they were still committed to a strong and growing dividend. Yeah. But look at the latest quarterly earnings report this week. They are committed to maintaining a competitive dividend. This is really a change in language. And where have we seen this before? Credits to my friend Dividend Wave on Twitter. He shared that actually AT&T was mentioning exactly the same. For me, this is the mumbo jumbo that typical board of directors use to actually start announcing that a dividend cut might be likely. Of course, if they would say straight away a dividend cut, it would scare the hell out of people. They don't know that yet. And also, I think it's really, really hard for an American CEO of such a blue chip company to cut their dividend. And let me share you why. They have retirees at the moment that were working probably 30, 40 years for Intel. They have been all those years dollar cost averaging via their own share programs in the company into Intel shares. For many of them, as we have seen with GE in the past, General Electric, it might be like 80% of their wealth outside of their normal pension. In other words, to live their luxury lives, they really depend on the dividend from Intel. And many of those might actually be people that Pat Gelsinger personally knows. He's not the youngest anymore. He's been homegrown there for a long time before he went to VMware. But it doesn't take away that he knows what it really means. This is an American society, not European. It means different to have dividend income from your long-time employee plans as a former employee. So this is why I think it's really hard for people like Pat Gelsinger to really just cut the dividend overnight here, unlike how it is in Europe, because European dividend companies, they have a bit of a different approach there. They also know that we are not so reliant on all those dividends. But hey, that's maybe a bit of a long story. Why I think this is different for American companies is so much more difficult. But if I look at my own model, right, I believe the dividend is unsafe. Yeah, it's not even questionable anymore, unsafe. And for me, unsafe means it will be cut. There's negative free cash flow growth over the last 5 years. EPS growth is negative. Negative payout ratio because they have a 9 billion free cash flow in minus. Take on top of that the 6 billion. They lost 15 billion in cash, let's say, this year, 2022. The only thing why it's still scoring points is their really strong balance sheet. They have a debt to equity of 37%, which gives it still really lots of room to go into debt and still maintain a good balance sheet. That's the only optimism here. But in my opinion, if I read the language already, I think they will see just how horrible Q1 2023 might still be. And if it is bad, they will cut the dividend. And otherwise, they might think like, we might be able to get away from it. It's not something that I would risk. So if I would own these shares purely from a dividend growth point of view, I would start looking elsewhere, get rid of Intel, and actually buy, for instance, some British American tobacco or maybe a utility company at a similar yield. Of course, with that, if you go into those kinds of stocks, you know that you will not get the capital loss back because those are typically slow growers in capital appreciation and are more focused on dividend income. But we mostly invest also for dividend income, so that would be your case then. But honestly, I don't really own Intel for dividend growth. I've been clear in that also in past videos. I see this mainly as a turnaround play that might give me value in the long term. So also from that point of view, my long-time followers know that I have a 10% of my portfolio allocated to value plays and growth stocks. That's where Intel fits in that bucket. It's clearly a turnaround play for me. But of course, I'm always hoping that they will maintain their dividend and grow their dividend. Yeah, because I'm also a dividend investor. That's why I like this combination so much in Intel. So what will I do with my shares then? Because from that point of view, I need to look at it as a value investor more than as a dividend growth investor. And when you think about it, what it really comes down to is Pat Gelsinger. Do we trust Pat Gelsinger or not? I always have liked this CEO so far because for me, he's an engineer. He gets what it is about. He knows what to do. He has a long-term mindset and really with a strong passion for the company where he has been homegrown, wants to really get this business back. I can see it. I feel it in every presentation that he says. However, financially wise, I don't think he's the strongest really. He has been together with his management in 2022 still. They have been forecasting a mid to high single growth in these 2-3 years now. We have seen a 30% revenue drop. It's not like they didn't know already that COVID brought a lot of sales for notebooks and such forward. So for me, this is a big miss in their expectation. And something that really also, deteriorates my trust a little bit in management here. Not so much from an execution point of view on their strategy, but rather from a financial management point of view. But I just mentioned strategy, so that's what it all is about then, right? So their IDM 2.0 is on track. I really like that they were able to lobby for the CHIPS Act. I also like that they are trying to co-finance things. I also like that they are still negotiating with Germany to help them with the investment for a plant there. And I like that in, let's say, 1 or 2 years now, you can see that here, the next new processors and such and chips are coming available, which are really then a result, you could say, mainly from Pat Gelsinger's execution and being an executive. And that's for me where really the proof of the pudding is in the eating, when we see those coming online and they see them really regaining market share again. So I'm still trusting Pat Gelsinger there a little bit, but my trust in their financial predictions is definitely lost. There are 2 small things why I'm still bullish also on this company. Firstly, of course, is the deal that they have with ASML. They will get their newest EUV machine as a first customer. They paid $10 billion upfront for that last year. I hope this gives them a first mover advantage. If they are able to get also design excellence back, they should be really, really doing well in 2025 and 2026 with regaining market share. The second one is just their balance sheet. I touched already a little bit on it because they have still 28 billion in cash and short-term investments. Combine that with 37 billion, that means let's say 9 billion net debt position based on this. And take that also on their equity of 101 billion, I think this company could still, like for 3-4 years, go into debt to fund all of this and still having an attractive balance sheet. However, there's a catch there. It might be that we will be seeing a credit rating downgrade. Currently, they have an A1 credit rating, which is a premium grade. But the company already got a negative outlook from Moody's. And exactly for what we are rightly seeing now, Intel's rating could be upgraded if the company achieves and sustains improvement in manufacturing execution from progress node, retakes market share, This is definitely not the case because what is also mentioned here, ratings could be lowered if the company's operational performance is unlikely to show a meaningful reversal over the next year. They have not shown it. This report is from last year. So yeah, I think we can also expect a credit rating downgrade in the upcoming year in 2023. If also a dividend cut comes on top of that, I do believe we will see much more volatility in the share price. And the share price that we're seeing today with $28 could still go lower. Now that we know all of this, so my trust is a little bit deteriorating in the management here, specifically from the financial guidance point of view and whether they will be on time to turn this ship around. It is then important really to think from a value point of view, like what are the future cash flows for this company? Now, what has the company been guiding for 2023 and 2024? They expected a neutral free cash flow, adjusted free cash flow. That means effectively zero in normal language. And 2025 and 2026 and going forward, they expect a free cash flow margin of 20%. I will use these assumptions a little bit to be inspired by for my modeling, because what I'm showing you here is actually what reality is. So in 2022, they had 63 billion. That's of course much lower than the 77 billion, the 79 billion 2 years before. We saw a 9.4 billion negative free cash flow. With the guidance of Q1 2023 of 10 to 11 billion in free cash flow and a pickup, hopefully again in the second part of the year, I'm taking a 45 billion revenue assumption for this year. I believe therefore that their operational cash flow, and that's what I should call it actually, operational cash flow, will be around 10 billion, 20 billion capex, based on the transcript that I saw from the earnings call, gives us still a 10 billion negative free cash flow. Remember, this is different than their own guidance from a while ago, but they dropped that because they are only guiding now up till Q1 2023. But then next year, I believe that first of all, the investment should come down a little bit again, although I think some of the investments will still be pushed forward also into 2025. But also the first new processes will come online and will start to be sold. So I think we will see, together with a better consumer spending again, a recovery in their revenue. Therefore, I estimate 55 billion, but still a 5 billion minus in free cash flow. So effectively what I'm saying really here, like over the next 2 years, negative free cash flow. Then in 2025, zero in free cash flow. And then comes my assumption, not taking 20% what the company has been saying before, but I work with 10% and 15% of sales. Also, I believe that from 2027 onwards, we will see 8% growth in free cash flow, not, for instance, the 10 to 12% revenue growth that the company has been guiding. 8% free revenue growth. So I'm also more conservative here. That's all important to mention. So conservative in my revenue assumptions, then more conservative than management. I'm more conservative also in the free cash flow yield based on revenue. But all in all, I believe that over the next 10 years, they will be earning around 100 billion in free cash flow. So knowing all of this, let's go to my discounted cash flow model. But first, I want to also share what reality is here. I believed that they would have in 2022 4 billion in positive free cash flow. Of course, it was minus 9.4 billion, and it just shows you how off I was. My baseline case at that moment in time was $49. Clearly, I was wrong here. I was way off. I was way too optimistic. And yeah, you know, sometimes you win, sometimes you lose. I have had times where I was conservative and the numbers were totally upwards from there. Look at Upfee as an example. Sometimes I'm on the spot, I nail it, and other times I miss it. That's the, you know, the art of value investing. But hey, we learn, we move forward, we take new information into account. So if I take my free cash flow numbers here that I had here, this 100 billion, if we discount this with a 12.5% into the future, and this 8% revenue growth rate from 2027 to 2032, and also apply it to the free cash flow, you will see that we start getting back. But, you know, it's a large discount rate, 12.5%. I'm not using anymore 10%. Interest rates change, so I expect more return from my investments. At a terminal multiple of 15, I believe that the company will be worth $33 per share if we divide it by the amount of shares outstanding that we have today. Currently, it's trading at $28. If we take a 10% margin of safety on top of my conservative estimates, I see the buy price at $30. So that means that for me, the company is still undervalued. Now, knowing this, what will I do with it then? Look, simple said, I own 1.3% of my portfolio in Intel. That's it, nothing more. I can allocate 2% maximum to this holding in my portfolio. I've also got Meta still there. I've got Google there. I've got some Alibaba there. I know Meta Baba also not doing well, but I'm still in there for the next 2 years. Intel will be on top of that. It actually looks like a losing bucket, this 10% for me, but hey, it's just a moment in time. Let's hope that in the long term, I will be more right than wrong. But that means that this year, depending on how it all goes, how the news comes out, when we see a dividend cut, it's for me not really anymore an if, but when. I could consider still adding a little bit more, maybe around the $25 range, maybe one time around $27. And that's what I will be doing. But I am really putting a ceiling in of maximum 2%. That's it. It's not worth having it more because in its core, I'm a dividend growth investor. The dividend is not safe here. This is rather a little bit speculation to really nurture my need as a value investor. Having said that, let me know what you think about this video. Let me know also what you're doing with your Intel shares. And guys, if you haven't done so, please subscribe, hit the like button, and see you next time.